Welcome to Capital Link's company presentation series.
Good day to everybody. This is Nicholas Bornoulis of Capital Link, and I would like to welcome you to Capital Link's corporate presentation series. We have with us today the management of Seanergy Maritime Holdings, Mr. Stamatis Tsantanis, the CEO, and Mr. Stavros Gyftakis, the CFO. A quick reminder on the disclaimer that this presentation is for informational purposes only. It is not investment advice, and it is not an offer to buy or sell any securities. It's just for information purposes. In terms of logistics, we start with a presentation, a slide presentation. After the presentation, management will be responding to questions that you can submit during this presentation by clicking on the button on your screen below, the Q&A button. Please submit your questions, and Stamatis and Stavros will be responding to them. And with this, I will turn the floor over to Stamatis and Stavros.
Thank you, Nicola. Good morning, everyone, and thank you for joining our presentation today. My name is Stamatis Tsantanis, and I'm the Chairman and CEO of Seanergy Maritime Holdings. Together with me on my left is Mr. Stavros Gyftakis, the company's Chief Financial Officer. And the purpose of today's presentation is to go through the highlights of the company, have some brief financial discussion, and save time at the end for Q&A and make it as useful as possible. So on that note, I would like Annie of Capital Link to start the presentation so we can go through the slides. Thank you. That's the first page of the presentation. If we can move to page number 4, please. Thank you. This is great. So a few words about Seanergy Maritime Holdings. Seanergy is the only US-listed company with a pure-play Capesize fleet. We have been listed on the Nasdaq Stock Exchange since 2008, and we have a modern, high-quality fleet of pure-play Capesize vessels. We are a very experienced management team, young and experienced management team. We have a very solid corporate governance and a fundamental focus on ESG, long-standing commercial relationships with some of the world's largest charterers that I will discuss later in today's presentation. And we have all of our vessels are actually operating in period contracts. And we have the lowest book value of the fleet as relates to the deadweight capacity. So that means that we have bought our ships cheaper than most of our, if not all of our peers. What I must say here is that we are an independent company. We have no sponsored ownership, and we have no affiliations with private equities or hedge funds. That means that our interests are fully aligned with all the shareholders' interests, and we have no business on the side making fees like private companies or things like that. So we're a truly independent company with a very transparent corporate structure. If we can move to the next slide, please. Here we have a short infographic that we have on the website for ease of reference. The key important point here is that the fleet has grown by about 65% over the last 2 years by investing $259 million in new vessel acquisitions in what we believe to be one of the lowest points of the market. Moving on to the next slide, please. Here is the fleet list of the company. As you can see, we have a very homogeneous fleet, high quality. All of our vessels have been built in either Japan or South Korea. And all the vessels are operating on period time charters that I mentioned before. We have a combined cargo carrying capacity of 3.2 million deadweight tons, which is a very substantial transportation capacity. And the average age of the fleet is 12.4 years. Moving on to the next slide, please. Here we have a slide that you can review at your own time if you want. We have it on the website. It's a brief history of the company since we relaunched our operations 7 years ago in 2015, and it discusses how we have grown our fleet from 1 vessel to 18 Capesize vessels that we have today. Moving on to the next slide. A few words about ourselves. Myself and Stavros, we're a very experienced management team. But aside from us, we have a great management depth with some high quality professionals that have been with the company for many years. And we believe we have one of the best teams running our vessels and our corporate operations among the industry. Our board of directors, we have three independent board members, 5 board members in total, and a combined experience of more than 100 years. So it's a very combined, it's a very experienced board, as you can see. Moving on to the next slide. A few words about the rewards that we have given to our shareholders in 2022, and that's a very significant slide here. In total, we have created a value of about $55 million, and that consists of a cash dividend, a stock dividend, and buybacks that the company has made in 2022. Starting with the dividend, we have paid a total cash dividend of 12.5 cents per share in 2022, and at the same time, we gave stock dividend of the United Maritime shares, which is about 3.2 cents per share. So on a combined basis, we're talking about the 16 cents per share or a 30% dividend yield that we have paid to our shareholders, either in the form of cash, the majority is in the form of cash, or through the distribution of United shares. At the same time, we have bought back $26.7 million of convertible notes, warrants, shares. So we're talking about a very substantial accretion of value and distribution of value to our shareholders, which is in the region of close to $55 million in 2022. Considering the fact that our market cap is about 100 million right now, a very undervalued market cap, creating a $55 million value for our shareholders, I think it's a very, very significant point. Moving on to the next slide, please. A few words about our ESG commitment. I'm going to start with the fleet and the environmental part of the overall picture here. We are one of the first companies out there that we have installed remote performance monitoring systems since 2015. And in combination with our charters, we are installing energy saving devices on the majority of our vessels, if not all of our vessels. So we strongly believe that our fleet is going to remain highly competitive until 2030, which is a big turning point for the global vessels out there. And we are among the pioneers in that sector. Now, we at the same time we have very high social sensitivity. So we want to treat our people both at the office as well as at sea with the best possible measures. We have free internet on board our ships. We have signed the Neptune Declaration, and we try to support our staff no matter where they are with the best possible way. At the same time, from a corporate governance perspective, most importantly, as I said in the beginning, we're a truly independent company. We have no private entities on the side making fees outside of Seanergy. We have a truly independent board of directors, and we're not a sponsored company, or we're not affiliated with any hedge fund or private equity or things like that. So we're talking about a true alignment of interest between management and the shareholders of the company. Moving on to the next slide. And the next one, please. Right, a few words about our clients here. It's a bit of a name dropping. As you can see, we do business with some of the world's largest charters. And we're not talking simply about chartering the ships on a period employment. We're talking about something deeper, which is effectively installing scrubbers or installing energy saving devices and discussing the future of the ship together with any of these names. So that creates a lot of value because we're all on the same table making decisions about the ship, whether that is called upcoming environmental regulations or new technological equipment that we can install on the ship, or a combination of the above, because we're proud to be doing business with some names that are fully open to innovation, and we have been at the forefront of innovation over the last 7 years. Moving on to the next slide. Stavros now is going to walk through the bank relationships of the company and some high-level financials. And I will come back to the presentation to discuss the market update. So Stavros, if you want to go ahead.
Thank you so much. Good morning also from my side, and a big thanks to Nicholas and the Capital Link team for hosting our presentation. So on the next slide, slide 13, that is, you can see an overview of our vessel financing and of our lending group. What is interesting to note in this slide is that basically out of the 9 financial institutions that you see here, only 3 were lending to Seanergy 24 months ago. So over the last 2 years, we have embarked in a very ambitious refinancing and new financing program, which saw us concluding facilities of 270 million in total, with the main aim being to reduce the applicable interest rate across our financings and to improve the overall terms, of course, in combination with funding the very ambitious fleet growth program. So through this effort, we have managed to reduce the average spread applicable on our facilities from 5.1% as of the end of 2020 to 2.9% as of the end of last year, which is an impressive reduction of more than 200 basis points. At the same time, we have expanded our lending relationships globally, concluding new financings in the prominent Asian market with Chinese, Japanese, and Taiwanese lenders, while also strengthening our relationship with the prominent shipping lenders in Europe. Our total gross debt stands at around 250 million as of the end of 2022. This includes vessel secured debts. It includes also the facility that we concluded at the end of last year for our newest acquisition, the Paroship, and it includes also some remaining convertible notes. The loan-to-value across our fleet is based on September valuations is below 50%. And maybe moving on to the next slide, you can see here the deleveraging effect is even more apparent and in combination with our fleet growth. As you see in the first graph, we have increased our fleet's cargo carrying capacity. It has almost doubled actually through the last 2 years. And at the same time, our corporate leverage and fleet loan to value has reduced by almost 50%. This is even more evident when we look at the debt vessels, at the debt figures on a per vessel basis, whereby through the last 2 years, we have completely eliminated junior debt, we have marginalized convertible debt, and we have reduced the senior secured debt to almost 50% of the average market value of our vessels. On the last graph, you can see an attestation of the fact that we have bought our ships cheaper than our competition, as the book value per deadweight for Seanergy stands almost at 50% compared to the average of our peers. Moving on to the next slide, a few words about our financials as for the first 9 months of 2022. We had 4,380 operating days, increased by 25% compared to last year as we integrate the additional vessels that we have acquired in our fleet. The time charter equivalent that we achieved was close to 21,000, which is at a premium to how the market performed in the same period. Net revenues were close to 100 million, while adjusted net income was close to 22.5 million. EBITDA and adjusted EBITDA were approximately 50 million, which is impressive for a company of the market cap that Stamatis discussed below of close to 100 million today. Moving on to the balance sheet, cash and restricted cash stood at around 26 million. This translates to around 1.5 million per vessel. Our aim is for our liquidity to stand always in between 1.5 and 2.5 million per ship, which we think that provides a comfortable cushion against adverse movement in the freight rates. The net book value of our fleet was close to 440 million. The actual market value at that point of the fleet was much higher, closer to 480 million. And the long-term debt, which we have discussed previously extensively, at that point was close to 233 million, resulting to an equity position, a book equity position of 225 million. Lastly, on the next slide, please, Annie, we have run some sensitivity scenarios and sensitivity analysis on our EBITDA exhibiting our operating leverage under different rate assumptions. Here you can see that in a market situation like the one that we experienced back in 2021, our EBITDA can exceed 150 million. And in fact, for every 1,000 increase in our time charter equivalent, our EBITDA increases by approximately 6 million, which exhibits our tremendous operating leverage. And with that note, I will turn the presentation back to Stamatis to discuss a bit supply and demand fundamentals for our industry.
Thank you, Stavros. Thank you. So moving on to the next slide, please. I'm going to discuss a little bit the demand and supply fundamentals and why we believe that this is now a very strong turning point for the Capesize segment. I'm going to start with demand, and I'm pretty sure that you're all aware that China has reopened, and the reopening of China is expected to improve a lot the industrial production, as well as the new incentives to support the very problematic housing market that has been announced recently. At the same time, please note that it's expected that the new coal power plants in Asia by 2025 is going to be, I'm talking about the new ones, 270 gigawatts. So I'm talking about a big supply of power plants that are going to be burning coal, and that's going to help coal demand significantly. At the same time, everybody believes that the iron ore and coal ton mile is going to increase over the next 2 to 3 years. Whether that's going to be more coal or more iron ore or more bauxite, we don't know. But overall, it's projected that it's going to remain stable or increase somewhat over the next few years. So moving on to the next slide, slide 19. That, in my opinion, is the most important point for the market because we are now in the lowest order book point of the last 24 years. So that means that the order book of Capesize vessels currently stands at the lowest point since the early 2000s, and for a number of reasons, not only the financial sense that it doesn't make to build new Capesizes, but at the same time, it's the overall uncertainty about the upcoming environmental regulations. That being said, we don't really expect that picture to change anytime soon. And the existing fleet, which is going to get older and older as the years will pass, will have to either slow down or invest heavily in order to become competitive from now until 2030. So we have to deal pretty much with the existing supply of ships over the next few years, and that's going to have a declining effect, which in our opinion is going to boost demand on a very sustainable basis. I'm talking about the rates on a very sustainable basis moving forward. So demand is going to be what it's going to be, stable or higher, and we strongly believe that it's going to be higher. But the biggest point here is the supply of ships, and that's the strongest point of the last 24 years. This is not going to turn anytime soon. So the supply, the lack of new supply of ships is going to give a very sustainable and prolonged improvement in the rates that we're going to be experiencing in the next few years. On that note, that concludes our presentation, and we'll now pass the floor for Q&A. So please go ahead.
As a reminder, please submit your questions to the Q&A button at the bottom of the screen, and Stamatis and Stavros are here to reply to them.
Right. So I see a question here that talks about capital allocation ideas for 2023 and how we would allocate capital between shareholder rewards, fleet growth, or deleveraging the balance sheet. Well, the answer to this question is that we intend to maintain a very balanced approach. Rewarding our shareholders is always a top priority for us, and we will continue doing that in 2023 as well. At the same time, we might be looking at various additional purchases without sacrificing our shareholder returns. And we might as well delever the company, but we already have a very aggressive repayment schedule on our debt. So this is not going to be an issue for leveraging. I mean, the company will have a net loan to value at the end of 2023 of something in the region of 40%, 40%, which is on the very low side. Right, now the next question is actually a very interesting one. And it discusses the compliance with NASDAQ and the minimum bid price. That's a very interesting question because, as I mentioned before, we strongly believe that the stock price of the company is highly undervalued for various reasons. This does not necessarily have to do with the company, but with the fact that we have seen super large capitalized companies like Tesla, like Apple, losing or Meta and all that, losing 2/3 of their market cap over the last years. So that, in our opinion, can be an issue. It's not an immediate issue, but we might be considering some sort of a reverse stock split in the near future. That is going to be highly supported by us. I mean, if we are to consider a reverse stock split, that is going to be supported heavily by repurchase of shares and my own personal purchase of shares. And that's going to give a very strong confidence to the market, because our intention and our strong consideration is to try to break way above the $1 threshold and make the company a marginable security going forward. So that's among our considerations right now for us and the board. We're not leaning towards any decision yet, but the minimum bid price is something that we want to consider in the next few months, and we will not necessarily going to wait for the passing of the deadline provided to us by NASDAQ. So we try to reap the bandits and resolve this matter better sooner rather than later. The other question is discussing about the repurchase of Class C warrants. The answer is yes. I don't know, did we announce already?
We announced this morning. Actually.
Yes, we actually announced this morning that we have managed to repurchase about 50% of the outstanding Class C warrants. And that, in our opinion, helps cleaning up the balance sheet a lot and eliminating potential dilution when hopefully the stock price is going to get better. So we're actually buying the warrants at a discount to their exercise price. And that we think is a highly accretive measure for our shareholders and cleaning up the balance sheet, cleaning up the capital structure quite a lot.
Correct. And maybe Stamatis, it's interesting to note here that the fact that every dividend distribution reduces the price of the warrants has made basically the warrants in the money. So this is looming dilution, which we manage. Basically, we're repurchasing shares at 20 cents.
Yeah,
that was colossally accretive for our shareholders.
Of course, that's great news. Now, another discussion is the rationale of the United spin-off. Yeah, I mean, the rationale behind the United Maritime spin-off is that we want to create a vehicle that will have a highly speculative and highly gain and distribution effect for our shareholders. We cannot do that with Seanergy. We have a long-standing relationship with the charter, so we cannot be buying and selling ships as quickly as we have managed to achieve that with United Maritime. United Maritime is a high growth, high return vehicle for our shareholders, and we have proven that, but that's a discussion for United. And for Seanergy, the rationale is to provide some sort of a dividend to our shareholders, which is about 3 cents per share, and that has been included into the overall distribution that we discussed before. The next question discusses the average cost of capital for the $250 million of debt. So, Stavros, you want to discuss
Yeah,
that?
of course. As we discussed before, the average spread is in the region of 290 today. So base rates are trending at around 4.5%. So all in, that takes us to around 7.2%. Now I see also that the gentleman here is asking whether we can break it down by fixed and floating rate debt. The majority is floating. We have around 50 million in sale and leasebacks which are of fixed rate. So it's around 20% of our debt that is fixed rate debt.
Right. Okay, so the next question is the current book value per share. We believe that the current book value per share is at about $20, $30. Is it something like that? Yeah, so the approximate book value per share is at around $20, $30 per share. The next question is about the reopening of China and why do we believe that the reopening of China is going to be beneficial for the market. Well, you know, when you live in a lockdown for the last 3 years, pretty much in China, that's not definitely very helpful for industrial production and overall housing market and expansion. I mean, if people are living in their own houses, how can they consider buying a new house or things like that? So when you talk about infrastructure investment and the building new houses and industrial production and everything that is going to help the economy to kickstart again and import more and more iron ore and coal for the production of steel, the reopening of China is exactly what you need. Now, obviously, any such sudden move like we have experienced cannot be without problems. Yes, everybody or a lot of people in China are experiencing the COVID situation where they, you know, where they didn't have that for the previous years with the zero COVID policy. I believe that once things smoothen out and we pass the Chinese New Year at the end of January, I strongly believe that this is going to be very, very beneficial for the market. The next question to discuss about the spin-off of United. Unfortunately, this is a presentation for Seanergy, so I'm not going to get into the United story right now, but we're going to have another presentation for United next week, and happy to discuss that. Next week if you want at the United presentation. The next question is the sustainability of the dividend. Well, I mean, right now, the company has a very low break-even, and we believe that we can sustain our dividend in the future. So that's, for us right now, we're not considering anything in respect to the dividend. We have very strong cash flow. As Stavros mentioned before, the EBITDA generation of the company is quite significant, even in a very weak market environment. So, you know, there's no discussion about the dividend right now. Another question is about additions and sales of the fleet into 2023. We expect to remain at pretty much the same levels between, let's say, 16 and 20 ships. We do not have any crazy aspirations to go up by another 65%. We want to have a balanced approach and a balanced distribution of capital in 2023. Focus on shareholder rewards, and you know, if we can find quality assets, dispose of the older ones and buy newer ships with scrubbers. And that's a very important thing that we need to mention here, is that the latest acquisition of the company has a scrubber, so we are benefiting from the scrubber premium. That's pretty much what we have in mind. So stable growth, if I can say, good distribution of capital for our shareholders, and that's pretty much the idea for 2023. We have another question about the CII score of our fleet. Well, right now we are at A, if I'm not mistaken. I mean, the majority of the fleet is either A or B. 2023 is going to be a testing year for the fleet. So we expect to remain compliant with CII. It's all about what kind of speed and transportation capacity we will be putting into place. It's too soon to tell, but the current score, if I remember well, is either A or B. So we're in pretty good shape as far as the CII is concerned. Another question that we want to discuss now is the Capesize market once again and the supply of ships. As I mentioned before, we have the lowest vessel supply of the last 20 plus years. We don't really see that picture changing, and that is going to give a highly sustainable and strong increase in rates because the fleet growth is going to slow. The available vessels in the water, the effective supply of ships is going to start declining from 2023, especially in the second half and onwards. And that is going to boost the rates on a highly sustainable basis. And the other question talks about our expectations for the dry index. Once again, we feel that the futures, the FFAs do not really represent our expectations for the market. So I don't really believe that the calendar 2023 of 13,000 on the FFAs is grossly 14 is grossly understated. I think as a worst case scenario, we're going to see pretty much the same rates in 23 as we saw in 2022. And on a good case scenario, we can move closer to 30,000. But that is going to be a volatile year. We all know that this is going to be a volatile year. We expect 2023 to be a volatile year. And Seanergy is in one of the best positions to capitalize on the upside. The next question is actually a very interesting question that talks about the useful life of our vessels. Well, right now we cannot make any predictions because there is a big turning point in 2030 that a big percentage of the global fleet will not be commercially viable post 2030. From now, which is 2023 until then, we believe that our fleet will remain quite competitive. That's why we have high quality vessels, and that's why we have bought ships at a great average age of around 12 years. So the allocation of capital has been quite successful so far. And we strongly believe that our vessels is going to continue be operational and highly competitive over the next few years. The next question discusses about purchases of additional vessels. As I said before, we will be buying hopefully ships. We will be selling some of the older tonnage. We expect to maintain a fleet size of anywhere between 16 and 20 vessels in 2023. Right now, we are focusing on quality. And by quality, I mean installing energy-saving devices, making sure that we take advantage of the scrubber premium and everything associated with making our fleet as high quality as possible and as profitable as possible. And that's what we have. That's what we have in mind. On that note, I don't really see any other questions coming up. So if there are no further questions, Nicole and Annie,
Well, as you can tell, Stamatis, we could continue for another hour here. So you got both of you a ton of questions, and thank you very much for this very informative exchange and the presentation of the Q&A. In closing, I would like to remind everybody that this presentation will be archived and available to be accessed upon demand, and I'm sure you will get a lot more replays as we did last year. So thank you.
Before we go, Nicholas, as a final statement from me and Stavros, I want to say once again that, first of all, thank you for organizing today's presentation. I think it's a great initiative, and it's good to put in front of so many investors or potential investors, quality companies like us. Seanergy, once again, is an independent company. We're not a sponsored company, and we're not related to any hedge fund or private equity. We have no private business on the side. And having said that, we have a true and absolute alignment of interest between ourselves as management of the company and all of our shareholders. And we're doing the best in order to generate the best possible returns for all of them. That has been evident in 2022 by distributing close to 30% cash and share dividend yield. And we expect to continue creating value and accretion for our shareholders going forward. On that note, thank you very much.
Thank you to everybody, and thank you, Stamatis and Stavros, of course. Thank you.
Thank you.